Hey guys, welcome to Financial Health and Wealth, where we educate you in various ways to improve your life financially and live long, healthy lives. Today we're going to talk about your credit and how to get to that top score. If you'd like to see more of this type of content, then like, subscribe, hit that notification bell so you'll know about future videos. Let's get started. A credit score is a number that lenders use to estimate risk. Experience has shown them that borrowers with higher credit scores are less likely to default on a loan. Your credit score, the three-digit number that creditors use to evaluate the risk when they lend you money, helps determine which loans or interest rates you qualify for and how much you'll pay. Landlords, utilities, and cell phone companies may also check your score before doing business with you. Dozens of credit scores may be attached to your name, including versions tailored to specific industries, such as auto lending. However, the two big consumer credit scoring models, FICO, which is used by the majority of lenders, and VantageScore, a newer model created by the three major credit bureaus, value similar behaviors when calculating your score, even if they weigh those factors differently. Both grade your creditworthiness on a scale of 300 to 850, with a score of 750 or above generally considered to be good enough to qualify for the best rates. Credit scores are generated by plugging the data from your credit report into software that analyzes it, cranks out a number. The three major credit reporting agencies don't necessarily use the same scoring software, so don't be surprised if you discover that the credit scores that they generate for you are a little different. The software used to calculate a great number of credit scores was created by Fair Isaac Corporation, FICO. The illustrated pie chart here shows a breakdown of the approximate value that each aspect of your credit report adds to a credit score calculation. Use these percentages as a guide. So 35% is your payment history, 30% are the amounts you owe, 15% is the length of your credit history, 10% are the types of credit used, and 10% is new credit. Both FICO and VantageScore prize on-time payments above any other factor. As long as you pay at least the minimum due each month, your payment history will stay clean, though you will rack up interest on your balances. Lenders typically don't report a late payment to the credit bureaus until it's more than 30 days overdue. If you make a late payment, it won't haunt you forever, but the impact on your credit score will diminish as long as you consistently pay your bills on time. Your payment history includes the number of accounts you paid as agreed. This section also covers any negative public records or collections that may be included under your name, as well as information on delinquent accounts. The next thing to look at is what you owe and the limits on your credit usage. Your credit utilization ratio is the amount you owe on your credit cards as a proportion of the total limit of each card, as well as the total limit for all of your cards in aggregate. VantageScore advises consumers to keep their utilization ratio below 30%. A general suggestion is to aim for utilization of 1 to 9% rather than 0, because you can pick up a few more points by showing that you're managing your credit well. You can improve your utilization ratio by spending less on your credit card and by asking your issuer to raise your limit. Applying for a new card could also increase your available credit, but having too many accounts showing balances can lower your score. Most credit card issuers report the balance from your monthly statement to the credit bureaus. To make the balance appear lower, dole out a few mid-cycle payments, or pay your bill shortly before the closing date for your monthly statement. Your length of credit history is also important. A long track record improves your standing and gives the bureaus more to evaluate you with. This slice of your score considered the age of your oldest account and the average age of all your accounts. Opening new cards may improve your credit utilization ratio, but it also lowers the average age of revolving accounts, which can lower your score. Note that a closed account in good standing remains on your credit history for 10 years, so you'll benefit from your track record. However, keeping no-fee credit cards open and using them now and again is smart to help your utilization ratio stay low. A mix of revolving and installment loans also boost your score, but don't overdo it when applying for new credit. Having hard inquiries on your credit report from potential lenders will temporarily shave points from your score. When you're shopping for a mortgage, student loan, or auto loan, inquiries made within a certain time period, typically between 2 weeks and 45 days, count as one inquiry. Credit scoring software only considers items on your credit report. Lenders typically look at other factors that aren't included in the report, such as income, employment history, and the type of credit you're seeking. So what's a good credit score? Credit scores usually range from 340 to 850. The higher your score, the less risk a lender believes you'll be. As your score climbs, the interest rate you're offered will probably decline, and borrowers with a credit score over 700 are typically offered more financing options and better interest rates. But don't be discouraged if your scores are lower, because there's plenty of options out there for nearly everyone. You can check your Vantage score free at creditkarma.com and your FICO score at Discover's Credit Scorecard. These are free to use but can be at least a month behind. Here's a screen share to show you what you can get from Credit Karma and how the process works. And here we are on the Credit Karma website. Fairly easy to get yourself set up, but if you want to look through first, you can just see some of the offerings that they have for you, the things that they give regarding monthly scores, updates. Also, we'll let you know if anything drastic changes with your score or if anything negative appears. I really like that as well. I do use Credit Karma myself, so highly recommend it. It's great because you don't have to worry about any fees, and you also can learn a lot about overall credit and how credit works through various articles and postings that they have on the website. As I said before, getting set up is really easy. You can just create an account. All you need is an email and a password, and you can get yourself set up, and you don't have to worry about being harassed or being, offers for buying things or paying for monthly programs. It's actually is free, guys, so you don't have to worry about that. As I said, use it myself, and I think that it's a really great benefit for anyone who just wants to learn about how credit works. As you see here, they do break it down. You can actually look in at individual items if you want to learn more about loans, auto loans, mortgages, how credit cards work, and some other resources that are available for you as well. So overall, even if you don't sign up, I do recommend that you go here and at least read up on some of these items, because it will be of a benefit for you. You can also get full FICO reports each month from MyFico if you don't mind paying a fee. You can get in-depth information regarding your scoring for mortgages, auto loans, and more instead of a single score. Here's a quick look at their website if you want to sign up. And here we are on the MyFico site. And as stated before, this does give you a lot more than you would get from Credit Karma, but it is a paid service. But you do get your 3 bureau reports from Experian, Equifax, and TransUnion, as well as over 24 different scores through the various scoring systems. As I stated before, different banks, companies, and industries will use different scoring systems. So with MyFico, you have the ability to go in and actually see what they are looking at. While with Credit Karma, you were getting a general overview, but also was a little bit delayed. Now, these reports are going to be once a quarter, so they're not going to be monthly in this case, but it's kind of a balance between how much you would want to know, especially if you're currently looking for a home or you're thinking about buying a vehicle at some point soon. Those are the two instances where I would definitely say you would want to, maybe look into paying for this for a couple of months. As you see, is the Premier plan. This is about $40 per month, and this is where you're going to be getting the majority of your information. While Advanced is $10 cheaper, you do still get your scores, but you just get a little bit less. And of course, the one that most people are going to run for is the basic plan, but you only get one bureau on there, so you kind of want to pick wisely. I would usually say Experian is the most pulled credit bureau when someone is pulling your credit, but I have had TransUnion pulled a few times as well. So you have to be mindful about that, and if you do decide to go that direction, then just choose wisely. To summarize, here are some things to watch out for if you want to improve your credit score. And they are: total number of past due items, how long you've been past due, how long it's been since you've had a past due payment, how much you owe on accounts and the types of accounts with balances, how much of your revolving credit lines you've used, amounts you owe on installment loan accounts versus their original balances, number of zero balance accounts, total length of time tracked by your credit report, length of time since accounts were opened, the time that's passed since the last activity. The longer your good history, the better your scores, total number of accounts and types of accounts. A mixture of account types usually generates better scores than reports with only numerous revolving accounts like credit cards. Number of accounts you've recently opened and the proportion of new accounts to total accounts. Number of recent credit inquiries, the time it's passed since recent inquiries or newly opened accounts. and if you've reestablished a positive credit history after encountering payment problems. The bottom line is, knowing how your credit score affects your new job, apartment application, auto loan, and the home buying process makes it imperative that you find out your credit score early on. Your FICO score plays an important part in determining the interest rate that a lender offers, or if you'll qualify for that new job. Fun fact, I've had my fingerprints, background, and credit checked so many times for work that I wonder if I have an FBI file somewhere. Thanks for watching, and as always, hit the like and subscribe button to keep getting future content, and go ahead and tap that notification bell while you're at it. Enjoy the rest of your day.